In today's video, we're going to talk about nine common retirement tax traps that you may face. Now, you're not going to face all of these at once, but I guarantee everyone watching this video will be subject to at least one of these at some point in retirement if they're not careful. Now, I'm not only going to explain what these tax traps are, but I'm also going to talk about how we can avoid these. We've got a lot of ground to cover. Let's get into it. Now, before we get started, for those that want to jump around, I'll include the timestamps in the description below. So first off, you're going to hear me use a couple terms interchangeably, whether that's tax torpedo, tax trap, marginal tax spike. All of these terms simply mean that you see a higher rate than you are expecting in retirement. So for instance, on the right-hand side of the screen, we have the 2022 tax rates for single filers as well as married filers. You see that we have a progressive tax system. This means that we expect as we take out more money from our retirement assets, we slowly pay higher and higher taxes. But the problem with tax traps is that they can spike your marginal rate. So you think you're in the 10% bracket, but in actuality, you're in the 26.8% bracket as we think about all of the things that are converging together to spike that marginal rate. So on the left-hand side of the screen, you can see a perfect example of this situation. So in light blue, we have the normal 2022 tax rates. This would be your ordinary income rates from withdrawing from things like IRA assets. But you can also see a couple other spike zones as we start to stack on additional tax hikes. So what you'll see here in purple is as this person is taking additional income, it's forcing more of their Social Security benefit into being taxed. And so they have an added 8.5% added tax within these given zones on Social Security. They also have Colorado state tax here. Now, Colorado taxes both ordinary income as well as Social Security benefits. And so they have another 8.3% spike on top of that. All said and done, when we aggregate these together, this person thinks they're in the 10% bracket. They're actually paying 26.8%. And this is exactly why understanding these tax traps are so important. As we discussed taking from your assets, whether we take from IRA assets, Roth assets, or taxable account assets, each of those will have a different tax obligation. And if you find yourself in one of these given spike zones, you will be benefited by taking from one of those specific accounts over the other accounts. And so not only understanding what your current tax graph looks like, but also understanding what that tax graph looks like as we move through time so we can develop a forward-looking tax plan is one of the most important aspects to putting together a very strong and optimal retirement plan. So now that you understand what I mean when I say a tax trap, let's start to talk through the 9 specific tax traps that you may face in retirement. So the first tax torpedo we're going to talk about is the Social Security Tax Torpedo. And we're going to start with this because this is the most common torpedo that nearly everyone will face because almost everyone has a Social Security benefit. And so we need to be cognizant of this torpedo. This is also one of the most confusing torpedoes. Now, the reason this is a tax trap is because the amount of your Social Security benefit that is taxed is determined by the other taxable income you have. And so, for instance, if you didn't have any other taxable income and you were just living off Social Security, well, good news for you, your Social Security benefit will be tax-free and you don't have to worry about this tax torpedo. But as you start pulling from other taxable assets, like your IRAs, for instance, it will force more of your Social Security benefit into being taxed. And so there's essentially a double taxation effect here. You're taxed on the IRA withdrawals, but you're also taxed then on the amount of Social Security benefits it moves into being taxed. Now, how this is all determined is through a formula called provisional income. And you can see this on the right-hand side of the screen here. You then take this provisional income number and you plug it into the table below this formula. So if you're a single filer and your provisional income is less than $25,000, good news, your Social Security benefit is completely tax-free. If it's between $25,000 and $34,000, whatever's within this zone, 50% of that moves into being taxable. If your provisional income is over $34,000, anything over that $34,000 mark, 85% of that will move part of your Social Security benefit into being taxed. Now again, this is a little bit confusing, so we'll go through a few examples here in a sec. But a big issue that I see, or a big mistake that I see from retirees, is thinking as soon as you cross over one of these given zones, you immediately are 50% or 85% taxable when it comes to your Social Security benefit. This is not the case. For instance, on the left-hand side of the screen, I have a table that lays out this exact scenario. So let's say that you're a married couple and you have a $50,000 combined Social Security benefit. Let's say on top of this, then you pull $20,000 from your IRA assets. Now you'll notice if you follow along in this table, you'll have about 14% of your Social Security benefit that is taxed. Now, as you start to pull additional income, let's say from those IRA accounts, And let's say that instead of pulling $20,000, we're now pulling $40,000. You'll notice now that your total Social Security taxability is 48%. And so know that this moves up gradually. This is not a tax cliff. Let's go through a quick example to show exactly what I mean. So on the screen, we're using a single filer here, and they have IRA distributions of $30,000. They have tax exempt interest of $1,000, and then their Social Security benefit is $30,000 as well. So we would take half of that for the provisional income formula. And so adding these together, we would find that this person has a provisional income of $46,000. And so what happens here is we see that they are over that 85% mark. And so they will be fully subject to that 50% zone. Now, there is $9,000 within that 50% zone when we go from $25,000 up to $34,000. And so 50% of whatever's in that zone becomes taxable. $46,000 is obviously in that 85% target. So what we would do is take $46,000, subtract out $34,000 as we look at this table, and we take 85% of that. We would notice that that is $10,200. We add those two together and we find this person's total Social Security taxability is $14,700. Now, let's say we added $1,000 of extra IRA withdrawals. We would see within the provisional income formula, this would bump up their IRA distributions by $1,000, thus bumping up their provisional income by $1,000. And we would see that in that 85% zone of that $1,000 withdrawal, it would move $850 into now being taxed as part of their Social Security benefit. And so this double taxation effect as we move through time will spike their marginal rate. Let me show you exactly what I mean with a tax graph. And so on the screen, I have a single filer's tax graph. Now this person lives in Minnesota and has about $30,000 of Social Security benefits, and they haven't taken anything else from their retirement assets. And we can see how this Social Security Tax Torpedo transforms their tax graph. So first, what we'll notice in light blue is the ordinary income rates. We see that they're 10%, 12%, 22%, it slowly moves into 24, 32, and 35. Again, we're looking at the light blue zones here. But we also now notice this purple zone, and this is what this Social Security Tax Torpedo creates. Again, the whole idea here is as they're taking additional income, it's forcing more of their Social Security benefit into being taxed, and now they enter this double taxation zone. And for this specific retiree, they would basically see that they could take about $13,000 worth of ordinary income and still not be taxable at all because they're underneath the standard deduction. And so they'll have IRA asset withdrawals, they'll have some Social Security taxability, but they're going to be underneath that standard deduction. But now once they start to move into these higher zones and they're in the 10%, 12%, and 22% bracket, we see their marginal bracket transform. And rather than being in 10, 12, and 22, they're in the 15%, 22.2% bracket, and even a 40.7% bracket. And this is because they're seeing their marginal brackets spike by 50 to 85%. Now, note here as well that when you add in state tax, especially if you are in a state that taxes your Social Security benefits, you will see higher marginal spikes because of this. For instance, this person lives in Minnesota. Minnesota actually taxes Social Security benefits, and so we see this bracket once again transform. They think they're in the 10% bracket. They're actually in the 20.3% bracket. They think they're in the 12% bracket. They're actually being taxed at 32%. And when they're in the 22% bracket, they're actually being taxed at more than 50% as a marginal rate. And so someone that's in this given situation wants to do a couple different things potentially. First off, if they have their IRA assets under control, then they'll want to lean on withdrawal order. And maybe rather than entering this 40.7% zone, if they needed to take something like $45,000 worth of income, the last $7,000 or $8,000 they'd want to take from Roth assets to completely avoid seeing this marginal spike zone. If somebody is prior to RMDs and they'll see that RMDs are going to push them into this zone, they want to start to begin heavy Roth conversions to avoid having those RMDs push them into this zone without really having any repercussion from that given tax spike. The next three tax traps we'll look at are all related to healthcare and retirement. Now, the first one, once again, is one that many retirees are going to face, and that's Medicare IRMA. Now, IRMA is a Medicare adjustment where you will see higher Part B as well as Part D expenses if you show too much income. Now, this can be quite a confusing tax trap because it's a 2-year look back, and it's not based off your taxable income. It's actually based off something called your modified adjusted gross income. We'll talk about what that includes here in a second. But with a 2-year look back, essentially when you're 63 and you're planning to file for Medicare at 65, the income that you show at 63 will determine what you pay at 65. And so again, this ultimately leads into needing, once again, a forward-looking tax plan to start to avoid these tax traps moving forward into the future. Now, on the screen, you'll see a table that shows these Medicare IRMA targets for 2022 based on 2020 income. And so if you're planning for taxes here in 2022 and you're performing things like Roth conversions, know that the IRMA brackets in 2024 will determine what you pay. Now, the tough and confusing part is we don't know yet what those 2024 IRMA brackets will look like. And so there needs to be a little bit of filling in and a little bit of estimations that need to happen on this front. Now, another confusing part of IRMA is that it's a tax cliff. Now, the Social Security Tax Torpedo was more of a sloping tax torpedo. This is a tax cliff. So let's say that you're a married filer in 2020 and you show a modified adjusted gross income of $182,001. Well, it doesn't matter that you're just $1 over this given target. You will have the full Medicare expense. And so you can see these given IRMA zones as well as the corresponding Part B and Part D increases. And also note that if you're a married filer, you can multiply these expenses by 2 because each of you may have this IRMA expense because of showing that higher income. And so this modified adjusted gross income target is a combination of your AGI, your adjusted gross income, and then you have to add in all of your tax-exempt interest. So with a AGI, an adjusted gross income, you don't get to take the standard deduction. So your taxable income will be far lower, but again, you don't get to take out the standard deduction. Find this AGI number by looking at your tax return. In 2021, this was line 11 of your 1040. And then you would add in any tax-exempt interest, and this would be that modified adjusted gross income target. Now, we actually see that these marginal spike zones are shown as a dotted line on the graph. The reason being is because if we transform this to a marginal rate, if you think about it, this person shows one more dollar than this given target, it's a tax cliff, and so they would have a $965 tax expense due to showing one extra dollar. You would see this graph look completely wonky and it would be all kind of scaled weirdly, and so they show this via these dotted lines. And what you can see is that once this person shows about $66,000, $67,000 worth of income, they will cross over into that first IRMA zone and see about $965 per year as an extra Medicare expense. Now, IRMA is just a 1-year penalty, and so the following year you will be adjusted based on that income you showed 2 years prior. And so what we'll notice is there is one zone right before the end of the 22% bracket, and then there's 3 IRMA zones that fall within the 24% bracket. And again, avoiding these, especially making sure you avoid the tax cliff, is very important to making sure that we don't see those marginal spikes. This is a pretty hefty cost if you just max out the 22% bracket without thinking about it, because you added an extra $965 of added tax expense because of IRMA. The next tax torpedo is for those that retire prior to Medicare. And they really have 2 options. They can go with some kind of COBRA insurance from work, or they can enter the ACA marketplace. And when they enter the ACA marketplace, controlling your income is extremely important. As you show less in income, you can earn a very large subsidy that lowers your monthly premium cost in a big way. For a married filer, you might go to having a $1,500 per month insurance premium down to as little as no cost for your insurance premium. Now, what is counted against you is something called reported income. And on the screen, we have the ACA Premium Tax Credit Modified Adjusted Gross Income and everything that it includes. So it includes all wages and taxable distributions, all of your Social Security benefit, even untaxed Social Security benefit, which is very important to not file for Social Security early because it can really throw a wrench in trying to earn an ACA subsidy. All pension and annuity income that is taxable, capital gains, passive income, unemployment benefits, and taxable interest as well are all included and counted against you. And to give you an example of how impactful earning a premium tax credit is, we have on the screen somebody that has an ACA modified adjusted gross income of $50,000 that they're reporting. Their estimated monthly premium would only be $228 per month, $2,746 for the year. What happens if they show $20,000 more of income? Well, now they would see their premiums jump to $496 per month, which would have a total annual cost of almost $6,000, and they would see a 16% marginal increase on the extra $20,000 they took of income just because of this ACA subsidy loss. And so let's translate this to the tax graphs and see exactly what this looks like in a slightly different scenario. Now on the screen, we have a married couple who are both on ACA insurance, and they have a base income of $25,000. You want to show at least some income so you're not subject to Medicaid. You want to be on ACA insurance. And so what we'll see from here is as this couple adds additional income, they will see a marginal spike, and a pretty drastic one, because they're seeing their ACA premium fade out. You can see that as this person adds about another $20,000 worth of income, because of the large subsidy loss that they are subject to, they're seeing their marginal rate spike to as much as 32%. Now, they're taking about $46,000 worth of income total, so they're really not taking that much, but they're seeing a very large spike because of this subsidy loss. Then we start to see, as they show additional income, this tax graph evens out, but nonetheless, they still have a premium spike because of this ACA subsidy loss. Once they move into this 12% bracket, that's only an 8.5% marginal spike. Once they move into the 22% bracket again, that stays at an 8.5% marginal spike. But nonetheless, they're seeing their brackets transform from 12% up to 20.5%, and then 22% up to 30.5%. So knowing these given zones, once again, is extremely important as we start tax planning. For a lot of retirees, it makes a lot of sense to set up your situation where once you move into those ACA years, we are taking from Roth assets, which isn't counted as reportable income, versus taking from some of your other taxable income sources. The next tax spike zone is a little bit smaller of a tax spike, and this is due to the medical deduction phase out. So within the IRS code, if you show a certain level of medical expenses relative to your income, you can itemize and deduct those from your income and gain some tax benefits from that. And so the current standard for this is once your medical expenses exceed 7.5% of your adjusted gross income, you can start to deduct those and itemize those. Once they're above your standard deduction, you gain a tax benefit for this. And so keep in mind here that as we have a smaller income, we can end up deducting more because we have a larger percentage as part of our AGI of medical expenses. As we show additional income, that 7.5% zone starts to rise and we can deduct less. Here's an example of what I mean. If we have $40,000 of medical expenses and our AGI is $85,000, we have $33,625 in allowable deductions. If we raised our income by $100,000 due to something like a Roth conversion, well, now all of a sudden our allowable deduction is only $26,125. We show an extra $100,000 worth of income, which eliminates about $7,500 worth of that given deduction that we could take. Thus, we have an extra $7,500 worth of income taxed at whatever rate we are currently at. Now, as I mentioned, this is a much smaller spike zone, but nonetheless, we can see this on this tax graph. Again, the reason it's a smaller zone is because you're losing out on a deduction and you're losing out on whatever that tax would be relative to that given deduction. And so what we see here is the higher your tax is in that given zone, the higher that marginal spike will be. And so within the Social Security Tax Torpedo, we see that this medical spike zone is about 2.9%. As we move into other zones, we see it's about 1.6% when we're in the 22% bracket, 1.8% when we're in the 24% bracket, 2.4% when we're in the 32% bracket, and so on. You need to be thinking about the income that you show, and oftentimes, again, this is a small spike zone, so I don't want you to focus on it too much, but nonetheless, we need to be including this within our tax scenarios, within our tax analysis. Now let's set aside talking about some of those healthcare tax torpedoes, and let's talk about some related to your taxable accounts and capital gains. The first one we're going to discuss is capital gain bump zones. And to understand what capital gain bump zones are, it's very important to understand how your income stacks in the eyes of the IRS. And so in terms of the IRS, you have all of your guaranteed income that stacks on first, things like pension income, Social Security income. From there, we have your IRA income that would stack on next. And then finally, you have your capital gains that stacks on last. I mean, technically Roth assets stack on last, but again, those are non-taxable. And so what happens here is as you stack additional income within those middle zones with, let's say, IRA income, it pushes your capital gains into being taxed at a higher rate, thus creating one of these marginal spike zones. On the screen is a very simple graphic that shows what I mean here. We have somebody prior to having an RMD, they have IRA income and they have long-term capital gains. Now their long-term capital gains, luckily, are within the 0% zone. But now they have an extra RMD that pushes those long-term capital gains up into being taxed at 15%. And so on that extra RMD, they have a marginal spike because they see another double taxation effect here. Now, there are essentially three different capital gain bump zones that you need to think about. Now, the worst of the three is the one that most of us would be subject to. This is when you move from the 0% long-term capital gains rate up to the 15%. The next one is when you're subject to net investment income tax. We'll discuss that here in a little bit. And then when you finally move from 15% up to 20%, and again, adding on that net investment income tax. And so let's look at what this looks like on the tax graph. Here we're starting out looking at somebody that has $25,000 of long-term capital gains, no other income. And so what we're seeing on the screen is as this person shows additional ordinary income, they're subject to the normal tax rates, really, because again, they have those long-term capital gains, but those long-term capital gains are in the 0% long-term capital gains zone. And so this person can show additional income and be underneath the standard deduction, not seeing any of their IRA distributions being taxed. Then they're moving into the normal 10% bracket, then the 12% bracket. But now this red zone is what we start to see with this capital gain bump zone. And again, this is a pretty hefty spike as we move from 0% into 15%. And essentially what's happening here, when this person gets to about $85,000 worth of income, any additional income from IRA distributions now starts to push some of those long-term capital gains up into being taxed at 15%. For every dollar that they have of ordinary income taxed income, they're forcing a dollar of those long-term capital gains into being taxed at 15%. So what we start to see here in red is this double taxation effect. As they take a dollar from their IRAs, they're taxed at 12% on that dollar, but it also moves a dollar of their long-term capital gains into being taxed at 15%. Adding those together, they're seeing a marginal spike of 27%. And again, this is going to last for $25,000 worth of that ordinary income until they cross into that 22% bracket, and now they're past that capital gain bump zone. The next spike zone we're going to talk about once again is related to capital gains and is called net investment income tax. And this is one I find a lot of retirees often forget about. It's one that slowly creeps up on you and is one that you can be subject to once you're on RMDs and see some very large RMDs, or when you're trying to deal with RMD situations and you're performing larger conversions. And this is an added surtax both on long-term and short-term capital gains of 3.8%. This is subject to married filers once they show an AGI above $250,000 and single filers once they show an AGI above $200,000. And so here's the tough thing and the reason this will creep up on a lot of retirees as we move through time. These targets are not adjusted to inflation. So the higher inflation we see, we'll see income adjust, we'll see investment returns adjust to that given inflation. But if tax targets don't adjust to that given inflation, we will see a lot of retirees creep up into these given tax torpedo zones and unfortunately see higher marginal spikes because of this. Let me give an example when we look at more of a forward-looking tax graph. So this is a given retiree that is in an RMD problem. Once they retire, they're in some lower tax brackets, as we can see on the left-hand side of the screen here. But once RMDs start in green, they're being pushed up into higher brackets. On the screen, I have this $250,000 target in a dotted black line. And as we can see, if this isn't adjusted to inflation, they're going to see their income slowly rise due to things like RMDs and just taking higher income through time. Most tax brackets adjust to inflation, but yet this net investment income target does not adjust to inflation. And so in the back half of this person's retirement, they will see a marginal spike on those long-term capital gains, well, and on short-term capital gains as well. And so we're using the same example that we used before with somebody starting with $25,000 worth of income. And as we see based on this person's situation, as they show additional ordinary income from something like maybe a Roth conversion, they will start to see this spike zone. So again, if they have $25,000 worth of long-term capital gains, once they start to show $225,000 worth of added income from other taxable sources, they will start to hit this net investment income tax. And we can see as this is an added 3.8% tax, it's going to spike their marginal rate by 3.8%. Now, this person would be subject to this given tax, whether they were showing additional ordinary income through a Roth conversion or whether they were showing additional capital gains. If we scroll down here, we can see their baseline long-term capital gains of $25,000. And we can see that as they showed additional capital gains from harvesting a bunch of capital gains for whatever given reason, once they pass $225,000 because they already have $25,000 of long-term capital gains, they will see that added 3.8% surtax. But once again, we see this added 3.8% surtax is just something that we need to be very aware of, especially as we're performing large conversions. And let's say we're paying taxes out of our taxable account. As we're paying taxes out of our taxable account, we may be subject to long-term capital gains because of as we're harvesting that given income to pay those conversion taxes, we have long-term capital gains. Well, the more that we show in long-term capital gains, the more we're spiking those long-term capital gains up into a higher rate, due to this net investment income tax. And so we start to see that a lot of these can hit a given retiree at any given time. Prior to 65, they have to be worrying about things like ACA insurance, as well as all of these given targets. Once they're past 65, they need to be worrying about IRMA and all of these specific targets, and things can get quite complicated. Tax trap number 7 is once again one related to capital gains, and this is for those that are tax planning intra-year and have a capital loss. You need to be very careful about showing additional capital gains when you have a capital loss harvested, because now you start to cancel out a very important tax benefit. So on the screen right here, we have somebody with a capital gain of $5,000 from selling a given asset and a capital loss of $10,000 from selling a given asset. If the year ended right now, they would have a net loss of $5,000. They'd be able to offset their income by $3,000. Now they happen to be in the 24% bracket, so that's a pretty big offset for their given situation. They would have their taxes lower by $720. Again, 24% of that $3,000. Their carry forward loss then, because they still have additional losses, but they can only offset $3,000 against their situation, would be $2,000 moving forward. Now, what happens though if we're intra-year and this person decides to sell another investment that's at a capital gain? Well, now they see in their situation that this capital loss that's offsetting against their income is completely canceled out, because again, we have gains and losses that cancel each other out mid-year. And so this can translate to a marginal spike as they start to show that additional $5,000 worth of capital gains. Here's what I mean. So on the screen, I have a single filer who is currently still working and is showing a taxable income right now of $122,300. This puts them in the 24% marginal bracket. They're also at a net loss right now of $3,000 that's going to offset their income, and is going to offset income again at 24% marginal rate. So what happens if they're thinking about selling additional investments that are at a capital gain? Well, as they start to sell additional investments and they have a capital gain that eats into that offsetting, they will see a marginal spike. We can see this on the screen right here, and they would see a marginal spike of 24%. And again, this would be if we're only looking at federal income taxes. If we started looking at a state tax that added on something like a 6% added tax, well, now all of a sudden the marginal spike in this $3,000 zone of additional capital gains would be, well, 30%. The last two tax torpedoes that we're going to discuss are ones that are somewhat unique to your specific situation. So let's say that you're currently working and you're close to retirement, thinking about things like Roth conversions, or maybe you retired early, but you still have children that are in school, in college. Well, there are certain education tax credits that you can earn if you're below a certain income and you're contributing to that child's college. One of those is the American Opportunity Tax Credit, and this is a maximum credit of $2,500 per eligible student. Now, understand that tax credits are more important than tax deductions. When you receive a tax credit, that is a subtraction from your tax liability. So let's say that you had a $10,000 tax liability, you received a $2,500 tax credit. Well, now your tax liability is only $7,500 versus a deduction. A deduction only lowers your taxable income, and the amount that it lowers from your actual tax is relative to the rate that you would be paying as you lower that given income, if that makes sense. So a tax credit is much more important, and thus you will see a much higher marginal spike when you're eliminating that tax credit. And again, this tax credit is 100% of the first $2,000 of qualified education expenses you paid for that eligible student, and 25% of the next $2,000. To claim this full tax credit, your modified adjusted gross income must be $80,000 or less if you're a single filer, $160,000 or less if you're a married filer. And so on the screen, we have a couple that retired early, and they have two kids that are still in college, and they're currently contributing to those kids' education, thus earning the American Opportunity Tax Credit. Now, their income that they're showing right now is $72,700. So it's relatively low, and they see the opportunity to perform Roth conversions. But if they just willy-nilly look at the normal income tax tables and perform conversions based on that, they will be surprised when they lose out on this American Opportunity Tax Credit. Because once they show too high of income, they will start to phase out that given tax credit. And we can see this on the screen right here. So they're in the normal 12% bracket, 22% bracket, but then they see the spike here of 47% as that marginal spike zone. And this given spike is phasing out that credit. And remember, this spike is much larger than that medical expense deduction because they're phasing out a credit rather than a deduction. The final tax torpedo is the earned income tax credit. Once again, this is a relatively small spike zone, but one that is very important for a very specific retiree. And so this earned income tax credit is essentially a tax credit for showing a lower amount of income. This is only from earned income as the tax credit describes. This applies to part-time working retirees under the age of 65. Once you're over the age of 65, you can no longer earn this earned income tax credit. Now on the screen, you see a table that shows the value of this given tax credit based on how many dependents you have within the household, as well as shows the given levels of income, where if you show too much income, you will start to lose that given tax credit. With the earned income tax credit, we are looking at a situation of a married couple who both filed for their Social Security benefit a little bit early and are filling in with a little bit of part-time income prior to turning age 65. Now they have about $20,000 worth of part-time income and a Social Security benefit of about $35,000. And as we see based on their tax graph, once they start to show any additional income from ordinary income tax sources, we start to see this earned income tax credit completely fade out. And because of this, we start to see some pretty large spikes really early on as they start to show this additional income. If we go down to their capital gain bump zone, we see this spike even larger. And the reason we see this spike even larger is because once they show a certain level of investment income, I believe that number is at $10,000, they completely lose this earned income tax credit. And so we see this spike even that much more drastic in that specific situation. So there you have it, 9 common tax traps that you may face as you move into retirement. Now, avoiding these tax torpedoes is quite simple, but that doesn't mean it's easy. You need a forward-looking tax plan that not only builds out your tax-efficient withdrawal strategy, but also builds out where Roth conversions make sense and why they make sense. We have 2 trainings on these exact topics right here that'll tell you not only the when, the why, and the how of each of these valuable tax strategies. Thanks for watching, and always remember, you don't need more money, you need a better plan.